The moment your first paycheck lands, 5 decisions get made automatically before you've even opened your banking app. Most people don't know any of them are happening. Average graduate starting salaries in 2026 are sitting at around £30,500, and that number sounds straightforward until you realise it hides a pretty wild split. The broader market average is £30,500, but at the UK's top 100 graduate employers, the median is actually £35,000. And on the other end, most graduates don't land roles at those top firms. Many at smaller companies or lower paying sectors start closer to £22,000. So before anything else, it's worth knowing which number actually applies to you, because the decisions this video covers play out very differently depending on where you sit in that range. Here's what this video is actually about. Most first paycheck advice tells you to budget with some 50-30-20 rule and open a savings account. That's fine. But there are 5 things happening to your money right now that nobody explains properly, and one of them is almost certainly already costing you. We're going to go through all 5. The last one is the one almost nobody realizes they're in the middle of, and it matters a lot more than it sounds. We'll get there. Before we start, subscribe if you haven't already, as it truly helps the channel produce more top quality content related to everything UK finance. Let's start with the one that's probably already affecting you, and you just don't know it yet. Pull out your most recent payslip and look at the tax code. The most common emergency tax codes in 2026 are 1257LW1 and 1257LM1. If you see W1 or M1 after your code, you are being taxed incorrectly. When you're paid for the first time, your new employer tells HMRC you've started, but if they don't yet have your previous income and tax details, you'll be paid using an emergency tax code. And here's the thing most people miss. A normal cumulative tax code looks at your total pay and allowance for the year and smooths the tax across every payslip. A W1 or M1 code can't do that. It taxes each period as if it were the first of the year, so it never reconciles earlier months on its own. In plain English, that means you could be handing over more tax than you owe every single month and just assuming the number on your payslip is correct. More than 5.6 million UK workers are currently overpaying tax because of an incorrect tax code. Collectively, over £3.5 billion. The fix is simple. If you've got a P45 from a previous job, give it to your new employer. That gives them your details and can take you off the emergency code. No P45? Complete the HMRC starter checklist instead. And if you've already been overpaying, once your correct cumulative code is applied during the same tax year, your next payslip recalculates the whole year and the overpaid tax comes back through your wages automatically. No claim needed. So step 1. Check the tax code on your payslip today. If it ends in W1 or M1, sort it out this week. That's money that should already be yours. Now, while that's happening in the background, there's a second decision that got made the moment you cross £10,000 a year in earnings, and most people have no idea it even occurred. Auto-enrolment. The second you hit that earnings threshold, your employer is legally required to enrol you into a workplace pension. The minimum total contribution is 8% of your qualifying earnings, at least 3% from your employer and 5% from you. But the way most people think about this is wrong. They hear 5% from me and think that's what it costs. It doesn't actually cost you 5% because 1% of that comes back as government tax relief. So your real cost is 4%. And in return, your employer puts in 3% on top of that. That's free money, 4% of your salary added by your employer and the government for doing absolutely nothing except staying enrolled. Here's where the decision in week 1 actually matters. You have the option to opt out within the first month for a full refund. And some people do opt out, usually because they want more take-home pay right now. That's a choice you can make. but what you're actually doing when you opt out is turning down your employer's 3% contribution and the government's 1% relief every single month. Over a career, that compounds into a genuinely large number. The money that stays in your pension is locked away until you're 55, which is the part that makes some people nervous, but the alternative, walking away from free contributions on day one, is the kind of thing that's very hard to get back later. So before you opt out of anything, make sure you understand what you're opting out of. Now here's something that trips up almost every new graduate who has a student loan. Most people assume repayments kick in immediately, like the first month you're earning, the deductions start. That's not how it works. Borrowers normally become liable to make repayments from the April following the completion of or withdrawal from their course, provided they are earning above the relevant income threshold. So if you graduated this summer and started a job in September, you won't see student loan deductions until April next year at the earliest. The threshold itself depends on which plan you're on. Plan 2 borrowers repay 9% of income above £29,385. Plan 5 borrowers above £25,000. If you started your course from August 2023 onwards, you're on Plan 5, and that £25,000 threshold is the lowest of any plan, which means if you're on a £30,500 salary, you're paying 9% on £5,500 a year. That works out to around £41 a month. There's also something worth flagging if you're on an older Plan 2 loan. From 1st September 2026, interest rates on Plan 2 and 3 student loans will be capped at 6%. That's a genuine change that came in this year, specifically to protect borrowers from inflation pressure. If you're on Plan 2, your interest rate going forward is now capped at that level. The bigger point here is that student loan repayments are not like commercial debt. Repayments are 9% of income above the threshold. They don't appear on credit files and don't affect mortgage affordability the way commercial debt does. So while it's real money leaving your account, it's not the same as a credit card or a personal loan. Don't panic about it. Just know what you're on and when it starts. Now here's the one that's much quieter but genuinely more dangerous for a lot of people at the first paycheck stage. On July 15, 2026, the UK's Buy Now, Pay Later market entered a new chapter, officially coming under FCA regulation for the first time. And this matters because up until literally this week, BNPL wasn't treated as real credit. There were no affordability checks, no formal consumer protections, no way to complain to the financial ombudsman. BNPL will now come under FCA regulation, meaning providers are required to carry out proportionate affordability checks to protect consumers from unaffordable agreements. Here's why this is relevant to your first paycheck specifically. The first paycheck creates a very particular psychological moment. You have more money in your account than you've probably ever had at one time. And BNPL is designed to feel like it's not really spending. You split the payment, the items arrive, and the bill feels abstract. BNPL is the second most popular form of short-term credit in the UK, with 21% of consumers using it, and among young people, around 39% of Gen Z have used it at some point. The purchases feel small. The average transaction is typically somewhere in the £60 to £100 range. Small enough to feel harmless. But the trap isn't any one purchase. It's that the habit forms in the first few weeks of having an income, when everything feels affordable and the money feels new. Around 60% of BNPL users aged 18 to 28 are currently holding 2 to 5 active plans at once. People aren't just using one, they're stacking them. And because BNPL has historically been invisible to credit checks, most people have had no idea what their total BNPL exposure actually looks like. The new FCA rules change that. As BNPL reporting becomes more standardized, lenders will gain a clearer view of an applicant's total debt exposure, which means your BNPL history will increasingly matter when you apply for a mortgage or a loan down the line. The era of BNPL being consequence-free is over. It's now real credit, and it's worth treating it that way from the start. And that brings us to the last one, the one I mentioned at the beginning that almost nobody realizes they're in the middle of right now. There is a live decision window open at this exact moment that closes permanently in April 2028. The lifetime ISA is set to be replaced by a new first-time buyer, ISA, in April 2028. The government launched its formal consultation on this in June 2026, and the new product is designed to be simpler. Under the new first-time buyer, ISA, the government bonus is paid when the funds are used to buy a house rather than up front, which means a saver can withdraw funds without penalty if their circumstances change. That sounds like an improvement, and in some ways it is. But here's what makes the current LISA worth opening right now before the replacement arrives. There is nothing stopping eligible savers from opening a new lifetime ISA before the replacement launches, which isn't expected until April 2028. A lifetime ISA allows UK residents aged 18 to 39 to save up to £4,000 a year and receive a 25% government bonus, up to £1,000 annually on contributions. That's a guaranteed 25% return on up to £4,000 a year before you've invested a single penny in the market. The current version also pays that bonus monthly, so it compounds inside the account over time. Under the new product, the bonus is paid at the point of purchase rather than added to the account over time, meaning savers miss out on investment growth on the bonus during the years they save. Only 17% of first-time buyers are currently using a lifetime ISA, meaning most are missing out on an estimated £3,000 to £5,000 in free government support. And the minimum to open a LISA varies by provider. Some accept as little as £1. You don't need to put in £4,000 today. You just need to open one before the window closes, because once the replacement launches, new leases won't be available. Opening one now locks in your right to contribute until age 50 and withdraw tax-free at 60. That's the decision window. You're in it right now. Most people won't know that until it's gone. So here's where we've landed. Your first paycheck isn't just a number, it's the moment 5 things happen automatically that most people never examine. Your tax code might already be wrong, and the fix takes about 10 minutes. Your pension enrolment is free money that costs you nothing to keep. Your student loan deductions aren't starting yet, and when they do, they're more manageable than most people expect. BNPL is now real debt with real consequences, so treat it that way from the beginning. And there is a savings window open right now that closes in April 2028, and the people who open a LISA this month will be ahead of almost everyone their age who waits. If you found this useful, drop a comment below, even just which of these 5 you had no idea about. It helps more people find the video, and genuinely, the comments on these are where I get ideas for what to cover next. And if you want to go deeper on any of these, whether that's how to actually invest inside a stocks and shares ISA, or what your take-home pay actually looks like on different salaries, that video is coming next.